Before we talk about specific investments, we need to talk about something that matters even more: asset allocation. This is the key. Now, don't let the fancy term scare you. Asset allocation is simply how you divide your money among different types of investments. Think of it like a recipe. If you're baking a cake, the ingredients matter. But just as important is how much of each ingredient you use. Too much flour and the cake doesn't turn out right. Too little sugar and it doesn't turn out right. Investing works the same way. The way you divide your money has a tremendous impact on how your portfolio grows, how it fluctuates, and how comfortable you'll feel during market ups and downs. In fact, many investment professionals believe that asset allocation may be the most important factor influencing long-term investment results. So what are the major ingredients? Let's start with the two most common. Now, let's start with our first major ingredient: stocks. When you buy a stock, you're buying a small ownership interest in a company. As companies grow and become more profitable, stock values tend to increase over time. Historically, stocks have provided some of the highest long-term returns available to investors. But, of course, there is always a trade-off. Stocks can be volatile. Sometimes they rise dramatically. Sometimes they fall dramatically. That's simply part of the journey. Next, let's talk about bonds. A bond is essentially a loan. You lend money to a government, municipality, or corporation, and in return they agree to pay you interest. Bonds typically don't grow as much as stocks over long periods of time. However, they tend to be more stable and experience fewer dramatic swings. Think of stocks as the engine that drives growth. Think of bonds as the shock absorbers that help smooth out the ride. Then there is cash. Cash is the most stable asset of all. It doesn't fluctuate much. It provides safety and liquidity. But over long periods of time, cash usually grows more slowly than stocks and bonds. Beyond stocks, bonds, and cash, investors may also own other types of assets such as real estate, commodities, precious metals, cryptocurrencies, or collectibles. We'll discuss many of those later in the course. For now, focus on the big three: stocks, bonds, cash, and now, here's the most important part. There is no perfect asset allocation. The right allocation depends on you, your goals, your age, your risk tolerance, your income, and most importantly, your time horizon. Someone who plans to retire in 30 years may be comfortable holding a higher percentage of stocks. Someone who needs their money in the next few years may need a more conservative approach. That's why your asset allocation should evolve throughout your life. As your circumstances change, your portfolio should change too. Remember the risk tolerance assessment from the previous lesson? That wasn't just an interesting exercise. It was designed to help you determine a starting point for your asset allocation. Now open your workbook to the section titled My Target Asset Allocation. Using your risk tolerance results as a guide, write down your target percentages for stocks, bonds, cash, other investments. Make sure your total adds up to 100%. Don't worry about getting it perfect. This is simply your starting point. As you learn more throughout this course, you can always refine your allocation. The goal isn't perfection. The goal is creating a portfolio you can understand, feel comfortable with, and stick with through good markets and bad. Because the best asset allocation isn't necessarily the one that produces the highest return. It's the one that helps you stay invested long enough to achieve your goals. Complete your worksheet, and when you're ready, join me in the next lesson where we'll talk about diversification and why spreading your investments around can help reduce risk while still allowing your money to grow. Welcome to Robertson CFP. Let's build your future together.